Okay, good evening, everyone. Tonight we're looking at financial reporting (FR), and our topic for tonight will be IAS12 income tax. Income tax is one of those standards under disclosures, and this standard is very important as long as we want to write financial reporting. Because based on my knowledge, I can have been testing this standard for quite a number of times now. So I will take my time to explain this standard from scratch, that is from the basis. Then we'll continue step by step until we finished the standard. Though the standard is very big. Okay, I want to say income tax. Now let's look at the objective of the standard. Now, the main objective of this standard is to determine the accounting treatment for taxes. That means is how can we treat accounting treatment for taxation. The main issues addressed in IAS12 is the accounting for the current and the future tax consequences of the future recovery or settlement of the kind amount of assets, which is or liabilities, in an entity's statement of financial position, and B, transaction and other events of the current period in an entity financial statement. Now, this standard is talking to how are we going to treat income tax, because there will be tax in our statement of financial position and there will be tax in our profit or loss. And each country has its own decision that on how they account for taxes or how they treat tax. That is tax law, but that is not what they're looking at in accounting. Accounting are looking at how does the IFRS, how would a tax you compute in tax computation, how will it affect the financial statement. Now let's look at the scope of the standard. IAS12 income statement must be applied in accounting for all income taxes. Income taxes include domestic tax on taxable profit, foreign taxes on taxable profit, and withholding tax payable on distributions. This standard talk about some definition, because we must understand some key definition, because subsequently in the course of this study we'll be seeing these definitions or these terms, so we should understand the definition. So I won't start explaining the terms any longer, so I'll be using the terms. Now, one, accounting profit. What is accounting profit? It's a profit or loss for a period before deducting tax expense. So that's accounting profit. Tax profit or tax loss in the profit or is the profit or loss for a period on which income tax are payable. When we say tax profit, that means you will pay our tax based on tax profit. That means the tax is paid on the tax profit. I mean, that is why before you compute any tax, when you pay any tax, you must first of all compute tax computation before you know the tax that you're going to pay to the government. What is tax expense? Tax expense? Tax expense is the aggregate amount included in the determination of profit or loss for the period for current and deferred tax. Now we say tax expense. So that the tax expense is normally the tax they provide for, and you adjust for the over provision and under provision. If there is any increase in deferred tax or there is decrease in deferred tax, you adjust for it. So that amount is your tax expense. That is what will show in our statement of profit or loss. Current tax is the amount of income taxes payable or recoverable in respect of taxable profit. For a period. Now, the major thing we want to talk about in this topic is not just how to compute tax, is the deferred tax. What is deferred tax? And what is deferred tax liability and deferred tax asset? When we say deferred tax, we're talking about the temporary difference. Deferred tax is a temporary difference between the tax in which the accountant will compute and the tax in which the tax profit will compute, or or the tax in which the government is deemed to be taxable or deemed to be payable to the government. So the difference between those things is called deferred tax, which is the temporary difference. And that temporary difference might be asset or liability. Deferred tax liability. What is deferred tax liability? Are the amount of income tax payable in the future period in respect of taxable temporary difference. Now you must understand the meaning of temporary difference. Now also deferred tax liability, we are talking about, okay, when there is a temporary difference, the tax that you will pay in future in respect of a temporary difference, or in respect of any profit, or in respect of any asset, or in respect of any expenses, is your deferred tax liability. That means you will pay it in the future, so it will come as a liability in your statement of financial position. Deferred tax assets are the amount of income tax recoverable in the future period in respect of deductible temporary difference. That is why the deferred tax assets might be your carry forward unused tax losses. So when there is tax loss, carry forward tax credits that you've unused, so is also a deferred tax asset or carry forward unused tax credit. Now what is the tax a tax base a tax base a tax base Now the tax base of an asset or liability is amount attributable or attributed to that asset or liability for tax purpose. When we say tax base, here we are saying your tax base is the amount of an asset or the amount of a liability for tax purpose. That means in accounting, the amount of an asset or a liability or expenses, that is the carry amount, the book value of the asset and liability. That's what we use. That's the term we use in accounting. But in tax purpose, we don't call it the carrying amount. We don't call it the book value. Is your tax bill. That is any amount in which you will complete your tax on. Any figure you complete your tax on is called what? A tax base. That means if your carrying amount for a non-current asset is 5,000, for tax purpose, you don't say carrying amount, you say the tax base is 5,000. So temporary difference. What is temporary difference? Temporary difference are difference between the carrying amount of an asset or liability in the statement of financial position and its tax base. Now when we say the temporary difference it warrants a deeper tax asset or a deeper tax liability when the carrying amount for the asset, that means for accounting purpose, and the tax base, they are different. It's not the same figure. Then there is a temporary difference, and this temporary difference will warrant a tax in the future. Now let's talk about current tax. The tax payable to or recoverable from the tax authority in the jurisdictions in which an entity operates is accounted for according to the basic principles of accounting for liability and asset. The current tax for current or prior period should, to the extent unpaid, be recognized as a liability if the amount already paid is in respect of current and prior period exceed the amount due for those periods. The excess should be recognized as an asset. The benefits relating to a tax law that can be carried back to recover current tax of a previous period should be recognized as an asset. Now, I want to say the current tax, your current tax should be recognized as an expenses, and that current tax, if not paid, it should be recognized as a liability. That means your current tax or your tax provision is you debit your profit or loss account and credit your financial position. and create your universal position. So that is how you get your current task. Now, task computation. Now let me draw our attention back to task computation. That means um to how we compute tasks in our taxation. So how do we compute tasks in our in taxation? Now this is based on the jurisdiction of the country the entity is operating on. So that is how they compute on the tax computation. And a series of adjustments is made against a company's accounting profit to arrive at a taxable profit. That means before you multiply the tax, your tax rate on the profit before tax, it must be your taxable profit, not your accounting profit, So, and how do you get your taxable profit? Is your accounting profit, then you make this adjustment, which is and this adjustment is one. Now the form which is the accounting profit before tax. That means accounting profit before tax, you will add back in admissible deduction, not you add back disallowable deduction in your tax according to your tax laws. So like a depreciation must be added back, and general provision must be added back. So then you will less admissible deductions. That means deduction which is some income that should be some income or some deduction that was not factored in the accounting purpose will be now be deducted before you now arrive at your taxable profit. When you arrive at your taxable profit, then you multiply with the tax rate. Then you now have your current tax, which is the tax payable. Now have your current tax. This is what will debit or profit or loss and credit to financial position. Now calculation of income tax expense. Now how we get the actual income tax expense? The actual one, this one is the provision. This is the provision. There must be other elements that will factor in before we debit it to our profit or loss. Income tax expense for the current period will be calculated as follows. If there is under or over provisions of tax in respect of the preceding period or charge in deferred tax provisions. So this is the format. Now the current income tax provision for the year, that means the one we compute using the tax laws, you want to compute above. Then you will add under provision of tax in respect of the previous period. You will add under provision of tax in respect of the previous period. You will less over provision of tax in respect of the previous period. So if there is over provision, you will less it. You will add increase in deferred tax provision, which is deferred tax liability. You will add it, or you will add then you will less a decrease in a deferred tax provision. You will less it. Then that is your income tax that will be included in your financial statement. Now let's look at this illustration to help us on this format given above. We said Bologina is a company. In 2012, it has an income tax liability of this. So this is our opening balance. The tax on profit for the year 31st of December 2013 was 114,000. So the tax on profit for the current year is this. The tax charge for the year to 31st December 2000 was overestimated. So this one is overestimated. That is over provision. So we have over provision of 6,000. During the year to 31st December, the company made a payment of this. They now make payment. We are told that you have to make payment. That when you complete your tax, The following year you make payment so to the government. So the amount you provide for in the previous year and the amount you now paid, the difference in what you provide for and what you pay to the government is what will warrant your over provision and under provision. So let's look at the solution. The solution. Okay, this is the solution. Now, in a statement of financial statement of profit or loss, the current tax, the current tax year, that is the current tax year that we pay for the current year, which is 2013, is 114,000. We are giving there is an over estimation, that is over provision in 2012, which is 6,000. And when you saw it from that, you will give us, you will less your over provision. You will now have your 108 as the what, as the charge, as the tax that will be paid in the current period. That is how we pay in the current period. We are told that there is an opening balance in 2000 that is the tax in 2012 December is 77,000. So this is the opening balance in your tax account. Then you had the tax that was provided for in 2013. That was provided in 2013. The one in your income statement, which is 108, you add 108, then you will have 185,000. Then we subtract amount that was paid, which is 123,000. Then the balance in your liability account will be 62,000 naira. Will be 62,000 naira. 62,000 naira. So this is the solution to the illustration 1. Solution to illustration 1. The solution to illustration 1. So our next class we will start from deferred taxation. This is the major item in the income tax IAS12. This is the reason why there is this standard, because there is always this discrepancy between the tax that we computed for account purpose and data we compute in tax purpose. So this is a major item. So our next class we will start from deferred taxation. See you in the next class.